Kind of what I'm going to go over is, ROIs or, profitability per acre, and then some of our specialty contracts that, that we've really started offering about a year and a half, 2 years ago now. And just, they're not for everyone, but for some people, they're a nice tool. So starting off, just diving into ROI and profitability, you're just looking at corn on where we are on the current market right now. We use $725 an acre as expenses. We know some guys that's going to be a little higher, some guys that's going to be a little lower. It just depends on input costs, your cost of rent the land and everything like that. So we're currently looking at about 200 bushel an acre, just trying to stay a little conservative there. I know a lot of guys use that number. And then if we're going 450, which I don't know what the market's doing today, I haven't had a chance to look, but if we're going 450 to 200 bucks an acre, that's going to be about 24% return on investment. If you're comparing that to something like the S&P 500, that usually gets about 10 to 11% a year. So it's kind of showing what your investment in your farm is getting this year. It's good levels. It'd be about 175 bucks in profit per acre if you just start pricing right now. We know not everyone's going to price everything right now. We got a long way to go, a lot of growing season left, but it's a good price point to get a start at, or at least think about it. And then just beans, similar story to corn. Good levels to start pricing out if you haven't priced much out yet, or if you haven't priced any out. If we use 550 bucks an acre for expenses. Yet again, higher or lower depending on each individual farm. But that would, if we're using 60 bushel an acre and about $12, cash price for that. That puts us around 31% return on investment. Yet again, if you're comparing to something like the S&P 500, which is 10 to 11%, that's pretty strong returns, and that's about $170 per acre. We haven't seen values like that, profit per acre, for quite some time. So I wouldn't be too greedy. I think we all think the market's going to go up a little bit more, but now's not a bad time to really start thinking about prices. Next, I'm going to just kind of go into some of our different contracts that we're offering, both OTC and then the minimum price contract, which is this one on this slide, also known as the guaranteed price contract. There's several different names for it, but basically the functionality of this is it allows the producer to set a floor underneath them while also having the potential to partake in the upside improvement on the market. There's two different ways you can go about it. The first one is you can do it by selling your grain to the elevator, so selling cash today and then buying a call back on the board. That's a popular way to go about it, or you can just basically buy a put, and then, when you execute it all, it'll all work out. I have two examples. One uses the call, one uses the put. The first one I'm going to walk through is the call. So let's say this is off yesterday's number, and I did round down just for ease of math purposes. If you sold corn at 475 futures, bought a 490 callback for 45 cents against the Dees, the minimum price you would get would be that 475 minus the 45 cents minus the 25 cent basis, let's just say we're setting it that day, minus the 2 cent fee. That puts you a floor price at 403. Now, where you would make money on this if the market just rallies up hard, we go above that 490 price, and then you'll start getting a little bit of return on that call. And like I said, if you are interested in that, because I know it's kind of hard for you guys, especially in the back, to see those numbers, but and then the put version of it is you just buy a 480 put. It's going to cost you 50 cents, and the math for that would be 480 futures is your guaranteed floor, and then you get the 50 cent cost of the put, 25 cent basis, 2 cent service fee. That puts you at 403 as well. So end result's the same, just two different ways of going about it. Next is some of our OTC programs. There's some pros and cons to these, some expenses, I guess. The first one I'm going to talk about is the accumulating min-max. Kind of the basic functionality of that is it sets a floor, which is that bottom green line, and then it sets a ceiling, which is the top blue line. Your ceiling on this in particular one is right around 550, and your floor is right around 450. Each day you're going to price out bushels, so it kind of functions like a daily average futures contract. So you size up 1,000 bushels. If you're on for 100 days, you sell 10 bushel a day at whatever the settlement price is for that day. The main cost of that is just cost you 11 cents. but there's no double up risk on it or anything like that. And then if the guy wanted to take the top end, if he just wanted to set a floor, but he thought the market was just going to rally hard, we can take that top off. It is going to make it a little bit more expensive, but it's still a good tool if you're really bullish on this market. Then next, look at another one for corn. It's our no knockout accumulator. It's one of our more basic ones. It's kind of the one when we first show to you guys. It's the one we show. Not necessarily the most popular. It's not necessarily the least popular. It's just kind of an easy one to understand. So you have a double up level and a knockout level on these. The double up level is the upper green level. The knockout is the bottom blue level. On this particular one, your knockout is at 432 and your double up is at 540. So kind of the functionality of that is if you're in between the 432 and the 540, you're going to receive 540 for that day's futures price. If you're, for some reason, fall below that 432, you're going to knock out the remainder of those bushels are going to be freed up. And then if you happen to, on expiration, which I have a full expiration until end of November, you're going to receive the 540, and then it's going to be double the amount if you're above that 540 futures on expiration date. Now, I will say this last year, these weren't the most attractive just because we started putting a lot of these in at low levels, right around that 350 range. And then we all saw what happened in the market. We just continued to rally and rally and rally. And it ended up hurting a little bit on the double up. And that's where we can take that double up off, but it's going to take a little bit off that top end. You won't be receiving quite as big a range. And then just look at the soybean version of these, the accumulated min-max. Like I said, it kind of functions. You price out every day. You have your floor and your ceiling. You're going to be somewhere in between that range at the end of it. You're going to have an average futures price. It's going to cost you about 12 cents. You're going to have a ceiling about $13.20 and a floor about at a $12 strike price. Yeah, those are good values. If we happen to hit the ceiling, at least you're hitting the ceiling at $13.20. Now we can always take that ceiling off. It's going to cost more. And then the knockout accumulator for the beans, we have a floor or a knockout at 1183 and a double up at 1370. So if we double up at 1370, if you're referring back to the ROI or profitability per acre, that's a strong number to be doubled up at. But yet again, we could do some tweaking with this. We could also do one where we take out the knockout and set a floor up underneath it. It's going to, lower that top value down a little bit, but it guarantees you have, a certain amount of price now. And that's kind of all I had.
Mine won't be very long, but one of the things that we do, so my background, I came from retail, ag, for about 8-9 years before this, 10 years, somewhere there. So I kind of attached to the input side a little bit too. So one of the things that I do is track kind of ratio relationships. We all know inputs are going up, going through the roof. If we could get our supplier to sell us multi-years out, we would be all over it, right, with some opportunities. Inputs in PK, that's kind of difficult, just the way that market works today. But the one opportunity, there's diesel fuel. We know diesel fuel is going up. Garrett's going to discuss that after a while. But if you look at some of those programs and some opportunities in that $12 bean range, right? If we can sell some $12 beans in some of those programs, turn around and lock in diesel fuel for 22 at today's current levels, I think we'd all agree they're probably not going to be here again next year as they just continue to keep climbing over $3 now. That's an opportunity. Some of that corn, we're trading corn to the upper $4 on some of those programs. That's, looking back through time, if we think about what was fuel prices when we had upper $4 corn and $12 beans last time, right? Is that some opportunity to back that? So, and as we sit down and make those input decisions, we all know potash has been a great buy, right, for many years. We can go through the agronomic side if we want to put that out on the ground multi-years at a time, nutrient tie-up, nutrient leaching, luxury consumption, those types of things. Or can we come up with a way to lock in some prices, lock in some sales, and back-to-back those things over time? Phosphates, they're just kind of traveling trend line. That price is going to follow the nitrogen market pretty close. Nitrogen's skyrocketing. I know there's been some guys saying $250 a ton higher than they got it on last fall. Pretty astronomical. Fertilizers, I've heard some prices on the phosphates upward of $150 a ton higher to $200 a ton higher than last fall. Something to be mindful of going forward next year. So do we have some opportunities to hedge that stuff off, make some sales and back to back those things? That's kind of all I had. Like I said, the fuel component is very interesting. But that, like I said, that's an opportunity, I think, to look at, selling some grain for 22. Yes, this price could go higher, but we could grow 92 million acres of corn, 90 million acres of beans, and be sitting here in a completely different situation, and fuel still wanting to take off on us too. So do we have some opportunity to back those ratio values that are extremely good historically? The green highlighted boxes, that's a snippet of a 10-year track, and I've highlighted the best top 10%. So anything you see green box, we're coming out of a historically good ratio of grain prices to input costs. So fuel, we know we're kind of taking off out of that now. It's pretty obvious.